program. Matthew, you just want to click over to the agenda? Okay, so we're going to give quick update on federal funding and a lot of things happening behind the scenes. We want to bring you up to date on. Quick reminder on the GSE principal reduction opportunity and some updates on language preference and what's happening in the field there. The bulk of our conversation is going to be with Jim Carr about how we got to this financial crisis, how it's impacted communities and communities of color, and what the lessons are to learn from this. I think Jim is a powerful presenter. I think it'll be a very interesting piece. And then a quick reminder to join NHRC and strengthen our work. So let's get right down to it. So Matthew, what's the story on federal funding?
So just a few quick announcements we'll just kind of run through by way of recap. The same day as our last call 2 weeks ago, the Senate Appropriations Committee passed their THUD bill, which includes $47 million level funding for HUD housing counseling assistance, but also zeroes out the NFMC program. Not a huge surprise because the President didn't include funding for NFMC in his proposed budget, and the Senate had also zeroed it out last year prior to the House kind of stepping in and funding it at $40 million. So not a huge surprise, but also obviously not good news. The Senate THUD bill is actually expected to get to the Senate floor maybe early next week. So there's a pretty good chance that the Senate is going to pass a bill really that looks identical to what they passed last year. So again, not good news that NFMC is not funded, but you know, most of the work we were going to have to do was going to be in the House at any rate. The one really encouraging thing to mention about the Senate bill, so as folks know, it's been a while, so I'll just quickly recap. FHA and HUD had proposed a program they called HAWK, which was Homeowners Armed with Knowledge for First-Time Homebuyers. The idea was basically to give first-time FHA borrowers a break on their mortgage insurance premiums for participating in a series of housing counseling and education requirements, and it was kind of stepped up the deeper you went, and it was a really well thought out and a program that we thought was a really good idea to try as a pilot. Going back to FY 2015, at the very last minute, there was language included in the THUD bill that basically prohibited HUD and FHA from using any of their appropriation to fund a HAWK pilot. And then that language then was carried over last year and is still included in the current Senate bill. The good news is that Senator Menendez has been really interested in trying to get rid of this language prohibiting FHA from doing the pilot. They have for the last couple of years. They are planning to introduce an amendment that would basically take that language out. But the challenge has been trying to find a Republican who would help them, who would support it as well. The encouraging news is that Senator Kirk from Illinois, who's up for re-election and in a pretty blue state, so has a lot of reasons to kind of be supportive of some programs that Democrats are more likely to support. That he's potentially going to be supportive of the amendment, which would really increase our chances of getting it included in the bill that the Senate ultimately votes on. So that's all to say that for folks in Illinois, it'd be very helpful for his office to hear from you, letting him know that was the thing they flagged, is that they kind of liked the idea of the HAWK program, but it wasn't something they had been hearing from their constituents about. So for folks on the call from Illinois, it would be great actually if we could touch base, if you could just send me a quick email, but it would be great if we could generate some emails and phone calls to Senator Kirk's office. And just very quickly on the House side, the THUD subcommittee hasn't considered a THUD bill. The expectation is still that, so they're on recess when they come back, that they probably will take up a THUD bill. It seems unlikely that it's going to get to the full House for a vote, But our goals there, as I mentioned, are just either to make sure that NFMC continues to be funded as close to the current level as possible, or short of that, increasing funding for the HUD Housing Counseling account. So that was longer than I meant for it to be, but Bruce, I'll just see if you want to add anything, and it doesn't look like there's any questions.
Yeah, and I think we're coordinating with a number of the national groups. HPF's been very helpful on this, especially in the Coalition to Provide Intermediaries, but a lot at stake here in terms of our ongoing funding. So I would make two plugs. One was groups in Illinois. Please be very active on this HAWC issue with Senator Kirk and reach out to Matthew. We've also working with Housing Action Illinois and their network of groups. So this is a top priority here for really great impact. The second one is if you're from Eastern Kentucky and on this call, you really need to talk to Matthew. We are very much involved in what the funding will look like next year. Hal Rogers is critical to this and is a Republican voice that's sympathetic. We have a tricky conversation to have with him, and we would love your input and engagement. So please, anybody who ever gets an email or call from Matthew, it's because we're really trying to pull off things that will just make housing counseling more sustainable, but especially right now in Eastern Kentucky, we need your engagement. Okay, thank you. Very quickly on the principal reduction model that has been used with the GSEs. We talked about this 2 weeks ago, but want to keep this on your radar. So it's a smaller pool than we would have hoped for, 33,000 eligible homeowners, but they're only expecting a 9.5% take-up rate, and we're hoping to bump it up to 15% with principal reduction. The principal reduction will be, instead of a forbearance balloon, they'll get that all wiped out. So it's incredibly valuable for people, for the lucky people that qualify. And the criteria is pretty, is restrictive, which is disappointing, but is pretty clear. And so think back on your portfolios of anybody you've got who might have a Fannie Mae or Freddie Mac loan and has a principal unpaid balance of $250,000 or less, and LTV greater than 115%. They, of course, need to have been at least 90 days delinquent by March 1st. So this is not something that people can go delinquent and get. This is, they're already at that place. But they could be substantially delinquent. They could be, 240 days late. I mean, it's the point here is that there's a fixed pool of these people. Our interest profoundly is to get as many of these people to qualify. It's obviously very much in the interest of your homeowner, but it's also, if we can show that principal reduction was a useful tool in making modifications more likely to happen and more sustainable, which is a lot what Ocwen has shown with their program as well. But if Fannie Mae sees it and does it, then we have at least a better argument to why these things work. So please look through your portfolios, and if you've got anybody out there who potentially could qualify, it'll be done as a streamlined mod, and the step into where they would normally get forbearance, that will be forgiven over time, over 3 years. Another quick update is on language preference. We are continuing to work to build it into the system. We got shut out of the mortgage application and have a joint project with Fannie, Freddie, FHFA, and CFPB on trying to figure out how this all might work. An interesting thing is that the CFPB is reopening TRID, Truth in Lending, and RESPA disclosures. And in that, there's a requirement that you have to collect 6 data fields of information. So one thought we're having and discussing with inside the consumer advocacy community is, can we add a 7th one, which would be language preference. And then, I mean, it's a tricky issue, but I think it's another way of keeping this issue alive and getting the information hardwired into the system. The other thing is that we're having, in conjunction with the Americans for Financial Reform, a deep conversation with the CFPB about how to handle language access issues. So not just preference, but the whole gamut of issues in mortgage and servicing. And they have asked to broaden the number of voices that are participating in these conversations. So they're very happy with the level of participation of all the groups that are there now, but we're also interested in hearing more groups from the field and different voices. And I thought that this would be an opportunity for groups that might not normally have been part of the CFPB conversations, but work with people who are deeply impacted on language access, who could, say what the consumer experience is, to participate in these. Don't have to fly into DC. These will be meetings that you can participate by phone. We'll have people face-to-face in the meetings, but we expect that there will absolutely be call-in capacity. And so if you're interested in this, you can raise your hand by either shooting me an email or Matthew in the box. Actually, the best thing is probably to send an email to say you're interested, and we'll reach out to a few groups as well, but you can help move these things forward. So with those quick notes, rapid fire, let's move in quickly into our main presentation. So we have as our guest Jim Carr, who hopefully many of you have know of. Jim has a long and storied career in the field of producing research, but research that has deep value in the work of forming housing policy and advocacy. Jim was at NCRC for quite a while and did excellent work there, and before that at Fannie Mae and the head of their research programs. But Jim's also been a useful voice and participant in many of the kind of forums that have helped develop progressive program policies around our time. And we wanted him to kind of join us partly because we've been in this conversation which we're really trying to get our arms around about the impact of housing policies over time, and particularly how they've affected low and moderate income people, how they've affected communities of color, how it's impacted communities that are African American, Latino, and Asian, and how they have reflected on what the wealth gap is and what we need to think about in terms of policy in order to maybe make our work better and certainly our advocacy better going forward. So with that note, Jim, welcome.
Thank you, Bruce. I'm both delighted and honored to join you today for this conversation. And I picked The Big Short because I thought that would be a fun way in sort of revisiting history, but revisiting history and the future through the eyes of the general public, because many people to this day have no idea why Blacks and Latinos are in the current housing state that they are in terms of low home ownership and poor wealth accumulation, but even more so, have no clue what happened during the meltdown of the housing industry. And the reason I think this is important, and I picked Michael Lewis's The Big Short, and I picked the movie, not the book, the movie, because that's the way in which most people will experience his writing. Now, his writing, the book, I thought was excellent. So I'm not in any way criticizing. In fact, I enjoyed both the book and thought the movie was just totally hilarious. But I could enjoy the movie because I knew between the lines what was going on. But I thought it would be good to just start off real quickly by refreshing you if you've seen the movie with the short clip. And then I'm going to go through this PowerPoint very, very quickly in order to sort of get to where we are now and where we need to go going forward.
So we are trying for the first time to launch a video. Give me just 1 second. We were having some trouble earlier, but I think that we have figured it out. But we need just 1 second.
You'll be our test case here.
Michael, how are you?
I found something
not have audio?
really interesting.
No, I'm not hearing anything.
The whole housing market is propped up
I'm
on
sorry,
these
I'm
bad
gonna
loans.
not try to figure this out. I apologize,
housing
Jim, but
market
maybe we'll
is
just
rock
keep
solid.
going with the presentation.
Yeah, no problem at all.
So technology foiled us this time, but we'll go back to the slideshow.
No worries. We don't really. It was fun, but we can do without.
You need to reload. Give us just another minute here as we're reloading here. Is that where you want to be, Jim?
I want to be on the slide that precedes this. And if so, it would be good if I drove it because I'm really going to be going very quickly.
Okay.
But if not, we'll go. I'll let you know. Okay, so let's just start off. So The Big Short was a really fantastic movie that explored the brilliance of a gentleman named Michael Burry, who was not a financial analyst by training, but was an MD. But he was considered a mathematical genius. And he is the one who really washed up on the shore of finding something out, which was the loans that were underlying so much of the securitizations and bonds and swaps and everything else were, in fact, basically junk bonds. And so he realized that, we went through a mortgage-backed securities process that was increasingly complicated. We went from mortgage-backed securities to, let's go to the next slide, to collateralized debt obligations, all the way through to synthetic CDOs. The point of this conversation is not to go through each one of these, but it is to talk about how each level of these transactions, like going from the CDOs where in fact junk bonds were basically rolled together to create a whole new investment vehicle in which what was rated as junk was now AAA, all the way to the synthetic, which really represented gambling. You didn't even have to have a direct interest in the underlying loans that were being sold, all the way through to, as you see on the next slide, there's a group of people who are talking. It took them a lot of work. Now, this is a part of the movie where I started really just smiling myself, almost out of a chair. So you see a group of people talking about what's going on. You can go to the next slide. They are working so hard to try and figure out what's going on with the subprime market. They're flustered, frustrated, lying on their desk. Michael Burry even is shown prominently walking around barefoot in the movie because he's that brilliant. He's figured out that subprime bonds may be heading to foreclosure. And as you can see, these gentlemen have so many papers on their floor trying to figure things out. And at the end of the day, it turns out that they do figure out that the subprime loans are faulty. The borrowers, of course, in the movie, all of them are represented. Every one of them was represented as basically someone who was in on the game, who knew that that they were buying houses. They were buying 1, 2, 3, 4 houses. There's one in which someone, a woman is talking about how she owns 4 homes. And so importantly about the movie to the general public is everybody was a deadbeat credit, right? They couldn't afford the loans. They took advantage of the system. Yes, they make the point that there may have been fraud within the financial institution, but they make the point really that it was people equally in on sort of the exploitation of the housing market. As you know, in 2007, Bear Stearns fell, followed immediately by Lehman Brothers. And Lehman Brothers meltdown led directly to the fall of practically every other major financial institution, all the way down to the financial crash of 2008. And the last slide here is, and that's the end of the story. The thing that's really interesting is for us in the housing and community development industry, that was not even the beginning of the story. So many of us could have saved Michael Berry and many others a lot of tireless nights to just have read a few papers. So this was a paper that I co-authored in 2001, Predatory Lending and Overview, which basically said those loans were going straight to foreclosure. But it wasn't me. I'd like to take credit for having been the one who first washed upon the shore of subprime loans, but the state of North Carolina in 1999, as probably all of you all know, had already passed a anti-predatory lending law that had been set aside by the OCC. These loans, they knew, were going straight to foreclosure. The law was passed in 1999, so as you all know, we were working on trying to get these loans out of the market as early as the mid-1990s. Lots of groups, not just me, lots of groups were along to these conversations before me, including including NAFA. The Center for Responsible Lending, I think, deserves the most credit. Can we go to the next slide? They deserves the most credit because they're the ones who came out with that 2.2 million foreclosure prediction in 2006. Again, if those Wall Street folks had been reading Center for Responsible Lending research, again, they could have saved themselves a lot of work because those guys were brilliant enough to actually cough up a specific foreclosure estimate. As you know, many dismiss Center for Responsible Lending estimate as a wild sort of scare tactic, and it turns out it was neither wild nor a scare tactic. It turned out to be a pretty conservative estimate relative to the size of the eventual collapse. Now, when we talk about the story really didn't begin with Michael Berry discovering that subprime loans were a disaster. In fact, the story begins even earlier. It goes all the way back to The Color of Money, which documented before we had race ethnicity in the HMDA database, how the disparities in lending were so extreme in the city of Atlanta. And this study was so powerful, showing lending disparities, that it eventually won a Pulitzer Prize. There was another study by the Boston Fed, immediately upon HMDA data collecting race data. The Boston Fed came out with a study that showed, looking at all 26 factors in making a loan. So we're not just talking about income or even credit score. We're talking about house type, neighborhood location, et cetera, et cetera. I worked on a study that confirmed the Boston Fed study back in 1993, 1994 with the Fannie Mae Foundation, and then following that came the Decatur Federal Savings and Loan study, which ultimately became a lawsuit against Decatur Federal. What was important about Decatur Federal was they were found to be, they were accused of rampant discrimination, and it became, to my knowledge, the first successful fair housing case brought by the U.S. Justice Department. And so, but again, going back to the reality, everybody in the housing market knew what was going on. And the reason it's important to walk through the discrimination part is that the reason that African Americans and Latinos, as you all know, were disproportionately subjected to subprime loans is because conventional lenders weren't making loans to those households. They were being rejected at 4 times, 5 times, 7 times as high as whites, even when you control for income. But of course, we didn't have credit score data, and we still don't have it from publicly available HMDA data, but that is changing now. But at any rate, if anyone had just looked at the relationship between median household values and incomes, you would have seen this market is not sustainable. But if you just looked at what the rating agencies knew, so both Moody's and Standard & Poor's after the crisis, the SEC pursued them and looked for evidence as to how they could have somehow missed this extraordinary misrepresentation of the value of the loans that were being packaged for bonds and sold on Wall Street. And what was most interesting was that they found there was blatant misrepresentation. And so my favorite quote of all was the one that this deal could have been structured by cows and we would still rated it. There were more. There was more than blatant misrepresentation, though. There was also conflict of interest. where basically the raters were actually having conversations in email about, do you think we'll lose business if we rate these loans correctly? There was possibly fraud. Well, it's hard to believe that these other conversations were going on and there wasn't any fraud. But as you can see, there was actually speculation explicitly of fraud, again, found in these emails in the various bond rating agencies. And then there were finally a couple of quotes that I just love, which is, where do you place these things? One executive of S&P saying, this has to be the stupidest place I've ever worked. And, of course, George Bush's favorite quote, Wall Street got drunk, and now it's got a hangover. The problem is that it wasn't Wall Street that got the hangover. It was, in fact, the American public. And that hangover came in the fashion of massive foreclosures that literally destroyed neighborhood after neighborhood across America. The most significant damage, of course, was in inner city communities with the most financially vulnerable households. It certainly wiped out several new suburban communities where whole housing projects were, literally foreclosed upon. But the real and the most significant damage was inner city, mostly, disproportionately, largely people of color, financially fragile, and people who actually own their homes, because more than half of the subprime loans were actually refis. So we weren't talking about an effort by government to create new home ownership opportunities, and we weren't talking about people exploiting the system. Of course, that there was a lot of homes that went upside down, were underwater. It probably wasn't this bad graphically, but I do believe that this kind of depicts how many communities saw their communities, how their communities were left after the subprime crisis. A few things to point out is that where the movie projects everyone as exploiting the system, of course there were many people who exploited the system, but that came a little bit later, right? That came a little bit later with a lot of the option arms, interest only, pick a pay, as they started running these fraudulent loans up the income and credit score scales, and then you had a lot of investors coming in then. But a disproportionate share of the basic core subprime loans that were at the epicenter of the foreclosure crisis were to people of color, specifically, particularly African American and Latinos. The movie ends, as you recall, the movie ends by saying basically that Michael Berry and all the other characters who were working with or in concert or in some way similarly to him were actually able to benefit for the collapse of the housing market. The implication in the movie, and the implication, I think, for, unfortunately, a lot of Americans, was that the story ended where the housing market, the players who were most significantly involved, like, say, Bear Stearns and Lehman Brothers, went out of business, and the executives, lost not only their firms, they lost their money. The problem is that these three things are really critical. That the borrowers were the ones who actually got damaged the most, and they're not presented in the movie in any way that talks about who was actually responsible for the crisis. The group that were ultimately bailed out the first was the big banks, as you all know. And in fact, I will never forget that there was actually a 2-page, depending on if you count the cover, 3-page bill that Paulson had proposed that would give basically somewhere between $800 to $900 billion to the Treasury to buy any assets at any cost, hold for any period of time from any financial institution. And that was actually a serious piece of legislation for, $900 billion, almost $1 trillion. The ultimate package wasn't much worse, because at the end of the day, according to the TARP Oversight Committee and Elizabeth Warren, as you know, who was the chairperson of that oversight panel, they indicated that the federal government had overpaid substantially on the distressed assets. And the irony for community groups and housing advocates in that crisis was the banks had a big crisis on their hands. The problem was that the borrowers weren't able to pay their loans. So if we had prioritized the borrowers, we would have fixed the problem for the borrowers and the banks and our communities, and we could potentially have had a significantly less harsh Great Recession. But as you all know, the Great Recession was really driven by the fact that home prices were driven down by more than 30%. And so it literally was a crisis that almost imploded the entire financial system, the global market. What about the banks? Well, the Tarp Oversight Committee found also that that they weren't even sure how the banks were spending the money. And so not only was there a requirement or a demand that, in fact, the banks take those dollars and work with borrowers to avoid more crisis to the financial market and to the housing system. In fact, the borrowers continued to slip into an abyss of foreclosures, over 7 million foreclosures at the end of the day. And of course, what happened to the banks? Everyone reeled about how big the banks were. They needed to be made smaller. But in fact, it was found that as a result of the way the banks were bailed out and encouraged by other banks that were failing or considered weak, in fact, the big banks became even bigger. Now, that was as of 2008 to 2013. But just recently, just in March of this year, there was an article in the New York Times that makes the point that we still are not out of the woods on too big to fail as a problem. Now, one of the things that was interesting that happened is the movie doesn't intentionally, I don't think at all, present a picture that says that it was, you know, that blacks and Latinos and other financially vulnerable households were were abusing the system. I think they tried. I mean, they say they imply that, although they don't imply disproportionately people of color. But I think the movie was just trying to be fun and exciting, and they do pick a small share of people who were abusing the system. The problem is that that scenario has been probably the most significant impediment to getting the housing market back on track, because what has happened is there's been an enormous amount of research conducted that literally invents numbers. And I showed this one study from the Center for American Progress because I had never seen a more damning title of a review of research. But I think the writers were so frustrated that you got aiming at folks who were actually a significant share, according to the Federal Reserve in 2006. More than about 60% had credit scores that would have qualified them for prime loans. So we know that what was happening was not basically people of color and vulnerable financial households taking advantage of the system. Really what happened was the system took advantage of them. The people weren't all wild and crazy. As you could see, they were basically couples, African American and Latino couples, who were trying to get a loan. And when it came time to helping them, the help for homeowners was very different than the help for the banks. The HAP program actually at the end of the day, as of the end of last year, had denied the number of people who had said it was originally going to help, who had denied the vast majority of applicants. I think it was about 4 million. The next slide shows what was the reason for denial, and as all housing counselors know and pulled your hair out, the request for incomplete data, incomplete data, incomplete data. We all know that data was being lost, burned, thrown away, that housing counselors across the country could not have been more orchestrated. And it could not have been orchestrated in their similar views of how poorly the banks were dealing with homeowners who were in trouble and needed settlement, and didn't receive them. And then, of course, as you know, there have been several settlements. There was the 49 state attorneys general settlement. There were many others. The problem with not all of those settlements is that when you dug into them, and there are tons of articles, I won't go into them, that every single one of them was really severely flawed because at the end of the day, they didn't prevent foreclosures in any meaningful way. Now, the relationship between home ownership and assets is a very powerful one, and the fact that such a disproportionate share of blacks and Latinos experienced foreclosure, it compounded the damage of the wealth gap that had already existed prior to the recession. The Pew Institute released the most frightening study, I think the most alarming, that showed that the 10-to-1 wealth gap between African Americans and whites prior to the recession had jumped to a full 20-to-1, and a similar disparity for Latinos versus non-Hispanic whites. And if you're trying to rely on income to actually close that gap, you can see that that gap is not going to be closed anytime soon. And as I said earlier, right now, because of a lot of the misinformation about what caused the crisis, so much attention in the sort of post-foreclosure crisis has focused on Fannie and Freddie. They were the cause of the crisis, and so basically they need to be disbanded and turned over to the private lenders, the PLS market. But of course the PLS market was the market that created the CDOs and the synthetics and the rest of those products that nearly imploded the financial community. And so the argument is that we, the bottom line is that we are in a space now where we need a new housing finance system. So let's go to postscript. So right now, the housing market, as many have written about, is not only dysfunctional, it's out of date. It's not serving the American public very well at all. And if we go to the next slide, the Urban Institute put a really powerful number on it, highlighting that between 2009 and 2013, there were a missing 4 million, well, actually more than 4 million loans missing from mortgage origination that could have been originated if we were using the credit standards that were in place in 2001. 2001 is important because that was a standard mortgage market, much more, a basic conservative market long before the actual ballooning of the housing market. And if you look at, and if you consider that 2014 and 2015 weren't very different than 2013, you could probably safely add 2 more million to that Urban Institute number. That's not their number, but I'm saying it probably, if you did that same analysis, would show from 2009 now 6 million missing loans. Well, 6 million missing loans represent 6 million households of potential wealth, as well as wealth to community, as well as impact on GDP. Now, remember that color of money study? Well, the interesting thing is that the more things change, the more they stay the same. And the reason that I wanted to go all the way back to the color of money study is just a few weeks ago, the New York Times did a similar kind of report in Atlanta to show the relationship between how neighborhoods are recovering by race, ethnicity, and you can see their title, "This Can't Happen by Accident," where black neighborhoods still lag far behind those of non-Hispanic whites. So we still have a market that's closed to people of color, in which discrimination still continues, and a bigger problem is not just home ownership, it's the rental market. So the rental market is not performing very well at all, and as you know, the problems on both owner and rental are supply. And the National Coalition for Low-Income Housing has been repeatedly pointing out, probably for a decade now, how it is that a person earning minimum wage can't afford a fair market rent. And so you think that was the worst it could get. But their studies just show it just keeps getting worse and worse and worse, and there's absolutely not a single policy proposal on the table being significantly debated by Congress to relieve the affordable housing shortage for rental housing. So let's go down to the next slide, which shows wealth. One of the interesting things about when we think about the racial wealth gap being so large is that there's no way you can close it. And yet a recent study by the Research Institute in D.C., DEMO, showed that you could actually close the racial wealth gap by a full 30% for African Americans compared to non-Hispanic whites, and by a full I think it was 28% for Latino households. Can we go back up? Because we're right there. And so, as you can see, it's 31 and 28%. That is a huge closing of the racial wealth gap just to equalize homeownership rate. I point this out because if you go to the next slide, many people keep saying, well, we need to equalize education and get more African Americans and Latinos into college. It's true that if we get more people graduating from college, we will increase the income of those groups. But wealth is built by an asset, and that's why the increase in wealth is really, really not that great. And also, if we were to do this in terms of income, you would see the income wouldn't change that much either, because black college graduates have a lower median income than a white male high school dropout. And so the income is not wealth. And even if you look specifically at income, return to college, and they looked at several other opportunities. They found housing was one of the most substantial. Let's go to the next slide. And so what I proposed recently was that we have a housing market well, let me just say really quickly, I'm just going to go through these. Most of the proposals we have seen on housing finance so far have been on the need to get more private capital into the market. The next slide shows that, in fact, it wasn't the lack of private capital in the market. It was too much private capital and in the wrong ways. So the two periods of time where we had the most private capital in the housing markets were the years leading up to the Great Depression and the years leading up immediately to the Great Recession. And the other thing about most of the proposals that have been recommended so far, as the next slide shows, is that several of them almost dismiss the need to provide affordable home ownership opportunities by saying that those who don't meet the credit quality or credit standards of the new housing finance system should seek out FHA, which is basically institutionalizing a dual credit market, and for a host of reasons would not work. Let's go to the next slide. Because of these issues, the big issues, which is the need to jumpstart the home ownership market, the need to improve our support for affordable rental housing, and the need to create jobs as well in the process, so that, part of the affordability equation is what do you earn, and then what's the house cost, right? So if you're a millionaire, you don't have a housing finance, you don't have a house affordability problem at all. And so what I've said is that the programs that put African Americans and Latinos behind were the housing programs of the Great Depression, which were really brilliantly designed, and they created, they were responsible for the overwhelming share of wealth that was created for non-Hispanic white households in the years after World War II and leading up to, the 1980s and 90s, and still today, the largest single asset of the typical American household is the family home, although blacks and Latinos rely on it much more heavily due to a lack of other investment. So my proposal I put forward with the Urban Institute is the need for a 21st century housing finance system. I said that we can't just try to put together the housing finance system that we had before that didn't work. And so as you'll see, my goals for a housing finance system are basically, we needed to do what the housing finance system of the 1930s did. And that is, it met the needs for affordable and sustainable mortgage products, across income, wealth, and credit characteristics, explicit federal guarantee paid for by the borrower. That was not part of the old system. We had an implicit guarantee in which the profits were privatized and the losses were paid by the American taxpayers. We need to change that, because there's no way to get away from an explicit federal guarantee. The housing market is like a $9 trillion business, and if there's not federal support for that, a major lender or major institution running that system or driving that system, if they get into trouble, they're going to get bailed out. So we need to be paying the taxpayers for that by paying for it on an ongoing basis. The other thing is that we have to have adequate capital levels. We have to leverage private capital in the way that is most effective, and we must have an enforceable explicit duty to serve protected class households across the board. And when I say enforceable, I don't mean we need to have more writing about all the flowery things it should do. There need to be enforcement provisions whereby you potentially lose your access to the conventional market if you're not doing the right thing. So you'll notice in the piece that I wrote, I said the housing finance system needs to go beyond doing sort of what it does today. It needs to also leverage this environment of low-cost, historically low-cost interest rates. They still are extremely low by historic norms. There's still vast pools of foreclosed properties. We need to leverage those both for affordable home ownership as well as affordable rental, but not affordable rentals that's owned by private investors, but affordable ownership that's owned by a more sophisticated nonprofits who can basically manage those properties in concert with the goals and expectations of communities. We also need to institutionalize borrower counseling. This is something we've talked about for years. In a new housing finance system, this shouldn't be a maybe or possibility. We should be charging for it. We should be making sure that any borrower who needs it has access to it. And it doesn't have to be limited to just financial issues. It can also be broad-based education to people about what it takes to maintain a home. And based on the age of your home, what kinds of improvements you'll need to put into that home before you buy it, so you don't buy it and find out, you know, when the roof needs repairing and it's going to cost you $10,000, you weren't expecting it. We need to make sure that there is much more rental housing, and we need to go far beyond just low-income housing tax credit. We need to be able to create the scale and magnitude of rental affordable housing using new and innovative architectural forms to create maybe even smaller units, but much more creatively designed. And the final thing that pulls all of this together is that neither of those two should operate in a vacuum. The truth is, in my view, what we need is we need to follow up on what Obama called for in terms of a infrastructure bank, but ours needs to be slightly different. Rather than focusing on high-speed rail, which I strongly support, and I think we should have an infrastructure bank to accomplish that, what I believe we need is a community development a community development infrastructure bank that is capable of pursuing mixed income, mixed-use development throughout metropolitan areas, and is capable of actually working with communities on long-term strategic housing plans in which the incentive is low-cost financing, so that we don't have a whole lot of just a lot of talking and a lot more housing plans on paper of what communities are committing to do, but where we have literally developers elbowing local governments out of the way to access that low-cost financing so that they can create communities that are scaled and designed for the income of the people who will live there, right? Because there's only so much of affordable inclusionary housing. And it's debatable how much we really get out of a handful of units in a high-cost neighborhood for a community that can't relate to anything else in the neighborhood, including the services. So they may get better schools, but everything else, including their social network, may be lost. We need to be able to develop housing and community development projects and communities that are at a scale and a price at an income that meet what the borrowers need. And so my next slide just makes the point that in the 1930s, so as you see, there's more to the story. My concluding point is that if you look at the 1930s, and it doesn't require rocket science, during the 1930s, just between 1934 and 1936, we had the development of the Federal Home Loan Bank system, the Home Mortgage Loan Corporation that put a moratorium, complete national moratorium on foreclosures and allowed borrowers to access the new system, which was simultaneously being built. We put into place the FHA, the Federal Home Loan Bank system, and Fannie Mae all in a 4-year period. Today, our housing finance experts, regulators, lawmakers seem incapable of even instituting a new credit score. It's abysmal. it shows that the Big Short story is not yet over, because the American public is still not receiving the support that it deserves and that it needs. And so my point is, rather than thinking about all this high tech and how complicated it is, the truth is it's very simple. Let's make the housing, let's bring together Fannie and Freddie into a new government corporation, not agency. The difference is a corporation has many of the flexibilities of a private company. And so, for example, it wouldn't have to go to Congress every time it wants to initiate a new loan product, anytime it needs to adjust its pricing structures. Very much like the FHA has to go to Congress constantly, like seller-funded mortgages that were rejected when they tried to eliminate them in the early part of in the late 1990s, which ended up contributing a substantial share of FHA's overall losses. My point is, with an infrastructure bank, we can turn distressed communities into more vibrant, still low and moderate income communities that are stable over time. We need to be able to build neighborhoods in which we know that the pricing of the whole community, including the services, are priced right for the people who live there, such that we can have much more surety about the sustainability of it. The American public deserves it. They need it. And I believe that we, as housing officials, housing supporters, housing counselors, housing advocates, we need to demand that as we go forward on housing finance reform, we do not accept just simply going with the housing programs of the past, that we really need our 21st century system to be 21st century intelligent and be broader and be more powerful, so they can not only rebuild the assets of individual households and families, but also of whole communities, and contribute many times more to our overall national economy. And I think if we do that, we will have come out of the Great Recession in a way in which we can say, well, it certainly wasn't worth all the damage and the misery that it inflicted on American households, but at least we've come out of it in a way where we're better than we were before we entered it. And I'll leave it at that.
Well done, Jim. Very big and also comprehensive, very helpful. And I think for us, one of the things we're really thinking a lot about is what will be the next generation of our work with a new administration, and how do we queue up some of these issues in light of the current election and the idea of a new president and hopefully new Senate and more that will create opportunities for us. So very, very interesting. We do have at least one comment that I've picked up here from Dennis Ochira. I hope you're saying your name correctly. With the collusion taking place on such a high level, why did the mortgage brokers and loan originators take the brunt of fault and regulatory, looks like I lost a word here, regulatory issues? Well, so do you want to respond? And I'll have some thoughts as well.
Sure. I think I understand the question is, why was it the brokers and not the big banks? And the answer is because the big banks are always going to be protected as long as they represent a systemic risk to the financial system. And that's the problem with them. It's not that there's that much love for them in Washington, it's that they present a systemic risk. And so unless we get to a point where we don't have institutions that propose those powerful levels of systemic risk, or where we have absolutely assured that they have set aside the resources in order to protect the taxpayers when they default or fail in any way, we're going to constantly have the federal government jumping in to save them. And that is one of the challenges on sort of this too big to, at the end of the Big Short story says basically, you know, the financial firms failed, and they imply that the executives and the companies were punished. But they weren't punished, and they didn't all fail. Many of them actually got larger, and their executives got wealthier. And so it's just a matter of who's got the most power.
Jim, we've had a few people ask if we could share your slides with them. Is that all right with you?
Yes, I think that's fine. I probably should put, yeah, that's fine. That's fine. But let me send you a zip copy.
Okay,
So,
that'd be great.
because I don't want them to be edited.
Okay, great. So we'll follow up with folks on the call with slides. And just at least one other question. Someone said that they're curious and interested in your proposal for a community development bank. Is that something that you've written about, or is there any way folks could learn more about that proposal?
Yeah, so I wrote about it at the Urban Institute, and so I think I have there's a slide that references it.
Yep.
And I'm actually continuing to work on building it out further because it's something I truly believe in. I have to say the Urban Institute series, there was a piece by Jim Parrott and Barry Zigas and several others known to all of us. I thought it was a really nicely done piece on sort of the basic system of a housing finance system as a government corporation. So I'm feeling really optimistic that we've gotten out of where we were before with the proposals that basically were, let's take Fannie Freddie apart, spin them out to major financial institutions, and somehow they're going to serve the affordable lending requirements of the American public, and most of those proposals didn't take into account rental housing at all. It seemed to be totally unaware that rental housing is one of Fannie and Freddie's key missions, and if they did mention it, they simply said it should be handled separately. So I believe that it should all be handled together, and it's a piece that I'm planning. I'm not planning to. I'm actually working on right now, and plan to propose the fully built, fully designed system.
Great. And maybe just one quick last question. Sherry Pace said that her husband blames the government for the collapse. She keeps telling him it was Wall Street and the securitization of mortgages. Do you have any recommended reading to change his mind?
Sure. So if she looks through that paper, that Center for American Progress report, that was the piece that responded to, I think it was the Wallison piece on the role of Fannie and Freddie in causing the mortgage crisis. The paper is called Wrong Way, Faulty Conclusions Based on Shoddy Foundations. If you read that, you'll see that the report actually suggested that Fannie and Freddie, or Fannie, I think, control more subprime loans than were ever originated, ever. So that's kind of hard to believe that they not only owned all of them, they own more than have been originated. So, so anyone who looked at that study has, you just can't walk away from it without saying anything else. Basically, it redefines the definition of subprime loans, and the CAP study points out, for example, that the failure rate on LPS versus those loans by Fannie Mae was something like 6 times greater, et cetera, et cetera. So there's a lot of good data in that study. And it's a very easy read.
That's great. Well, thank you very much, Jim. This is very, very helpful. We will want to keep the conversation going in some ways about practical things that we can work on in the future that will help position housing counseling and opportunities for in communities of color and for low and moderate income people and our clients. So very, very helpful. I'm going to quickly, we're at the end of the hour here, so want to make a quick plug for groups to remember to join NHRC. We are obviously doing a huge amount of work that will help develop the sustainability of housing counseling, funding, great products and opportunities, but also conversations like this, which kind of raise the intellectual conversation about the work we do and its significance. We've also just rolled out a new discount for directors and officers insurance, which apparently saves a lot of money. And so very interested in groups that are members that are getting quotes on this. So please let me know what the results of your quote application is, because we'd love to tell groups some idea of the kind of numbers of what the savings are. Plenty of other benefits for being a member of NHRC, but hey, the reality is you're supporting NHRC. You allow us to do this kind of work and share this kind of information. So with that note, everybody keep up your good work. Eastern Kentucky and Illinois, you have a special role for us that can really help strengthen our work long term. And next call in 2 weeks, we're going to have the next step in our Innovations in Housing Counseling series, innovative program to work with employers and provide resources for employees with a group that's actually doing this work in Kentucky. So we'll have a deep dive there. It should be very interesting for all of us. And we may have some important updates on a number of the initiatives we've been talking about. So with that note, we'll talk to you in 2 weeks. Thanks. Bye.